Hello, everyone. Welcome back to Signal or Noise. This is episode 28. Charlie Bilello here, and with me, as always, Peter Mallouk. Peter, a lot of fun things to talk about today. First, 7 lessons from Jack Bogle. Do you say Bogle or Bogle? What's your preferred?
I've never heard Bogle. Is there a debate around this?
Well, you hear some people say it that way. I believe it's Bogle. I Googled it, and I heard him say it himself, so that was good enough for me. 2, we're going to talk about a 7-figure signature, a crazy story that was in the Wall Street Journal. And we're going to end, as we always do, with Signal or Noise, looking at a few updates from previous things where I think we said was all noise. And we'll get a check-in to see if that was actually the case. Okay, we're going to start today with 7 lessons from Jack Bogle. I was rereading Common Sense from Mutual Funds, absolute classic, and I quickly came up with 20 lessons. So we're going to do a part 1 and part 2. This is part 1. And Jack Bogle, just an incredible guy. I mean, some people have referred to him as Saint Jack for all he did for the individual investor. I love this kind of thing about Jack Bogle and saying, this was back in 2012. He passed away in 2019. He said the only regret he had, Peter, in terms of money is that he didn't have more to give away. And what a wonderful quote. He always gave more than half of his money to charity every year. I just think that's just a great sentiment to have.
Yeah, I mean, he's an incredible person. I think I've read every book he's ever done. He was so far ahead of his time. I mean, when Common Sense of Mutual Funds came out, I mean, there were no ETFs, there was no tax, all this stuff that's commonplace today. No one had heard of any of it. And what he was saying was really, really radical. And a lot of people in the industry really didn't like him because of it. And you throw in his cantankerous personality, he was kind of known for rubbing people the wrong way. He was quite the figure.
Yeah, he absolutely said what was on his mind. He didn't pull any punches. That rubbed some people wrong way, but I absolutely love that approach. And let's dig in to the lessons. Lesson number 1, no one rings a bell at tops or bottoms. Here's the quote. The idea that a bell rings to signal when investors should get into or out of the market is simply not credible. After 50 years in the business, I do not know anyone who has done it successfully and consistently. And here's the money part. I don't even know anyone who knows anyone who has done it successfully and consistently.
Yeah, I had this book and this quote in my first book, 5 Mistakes, because a lot of, you hear all the time in this industry, well, I'm just going to do this. I'm going to stay in cash until this happens. There's an election or the Middle East settles down or whatever in Ukraine. And of course, it doesn't work like that. The market's too dynamic. There are too many things going into it. It's not just about interest rates. It's not just about unemployment. It's not just about geopolitics. It's not just about the election. It's all about future earnings. And all of these things combined influence future earnings. And so you never get that bell rung. You never get that announcement. By the time the skies are clear, it's too late.
And oftentimes, though, we get that feeling. Like when I look at a chart like this, like my first instinct is, oh my gosh, it seems like it's run up a lot. This is the S&P 500 over the last year. And we look this year, and it's one all-time high after another. We talked back in January about all-time highs are not a signal to sell anything. Well, now we've hit 26 more after hitting that first all-time high, 27 so far this year. And here's the interesting thing, Peter, that I've looked at in terms of valuation. So a lot of people say, well, buy low, sell high, buy when stocks are cheap, sell when stocks are expensive. And perhaps that's a signal in terms of that's a bell. When it hits a certain valuation level on the upside, you should sell. When it hits a certain valuation level on the downside, you should buy. It's as easy as that. The difficulty is the market doesn't work like that. I'm showing you here all of the S&P 500 bear markets over time, and you can see from the most recent one and back through time that the CAPE ratios, looking at the S&P 500, have started at all different levels, right? The median CAPE ratio of 22, but we've seen a bear market start in the early 1980s at less than 10, right? We've seen it this past time at 38. And in terms of ending, it doesn't have to end. It doesn't have to come back to that historical average or median. I think this is a very important point that we've seen many times since 2009, because 2009 was clear to a lot of people, okay, this stocks are cheap. It seems cheap based on history. They're beaten down. We've had a recession. It was a long bear market. But then we have a bear market like 2020 or this last one in 2022, I don't want to diminish it. Like these were, 28% and 35% declines, but we didn't have that, let's say, huge, long, drawn out bear market like we had back in '09. And people were saying, well, it has to go down more for valuation to get cheap. And that bell was never rung, right? If you waited for that point in time, now we're back at all time highs and so forth. So I think it's just an important point for investors to understand there's no holy grail indicator on the upside or the downside.
100%. And valuations are not, it's shocking to people, but people assume market overvalued, it has to come down. Sometimes it can grow slower, right? There's a lot of different ways for market timing to not work out.
That's right. Okay, lesson number two. When in doubt, be conservative. I want to pick your brain on this. This is a quote from Bogle. So please don't forget that considering the probabilities of future returns only begins the decision making process. Decisions have consequences. If the consequences of being badly wrong about future returns would imperil your financial future, be conservative. And he's talking here, Peter, about the projections we all make in terms of you have a financial plan. What are you expecting for stocks? What are you expecting for bonds? What are you expecting for inflation? And he's saying error on the side of being conservative because let's say you say stocks are going to go up 20% per year. Well, then I don't need to save very much and I could withdraw more. And that's not a realistic expectation. How do you approach this in terms of, I know you do a lot of these types of plans with clients and you have to plug in something for these numbers. Is it your way of doing things as well to try to be conservative?
I mean, you've got to build in everything conservative into projection because the consequences of being wrong are devastating, right? You can't, if you've got a 90% probability of something working out, that's not good when it's retirement, right? You can't at age 77, if you haven't been working for 10 years, you're in the 10%, it didn't work out, and now you're going back to work. You really need to be conservative with these projections. You have to assume you're going to live a long life. You have to assume there will be inflation. You have to assume the real rate of return will be relatively low, like in a very tight bandwidth of what's expected, so that you have a very high probability of achieving your goals. And that's why using the expected returns is not optimal. You want to use conservative returns.
Right. Speaking of which, so Vanguard puts out these projections and they update these every quarter. And their most recent projections for US equities kind of on the low side here between 3 and 5%. Let's put the middle, let's say 4%. They're looking at international equities. They're looking for a little bit higher return. Growth stocks, they're saying, are going to have a hard time. Value stocks, a little bit better. What do you make of this? Do you do anything with this? I mean, Vanguard's not the only one who does this, but do you make anything of these projections? Do you think that now is a time where investors, after we've had a pretty good run up, let's say the last decade, valuations have expanded, should they be lowering their return expectations going forward?
Well, Bogle was not a fan of market timing, but he was a very big fan of the idea of regression, that asset classes eventually revert to the mean. And that's the projections you see coming out of not just Vanguard, but Goldman and BlackRock, which are they're all saying, hey, large stocks should have muted returns. US stocks should have lower returns in the future, and growth stocks should have lower returns. Well, what are the best performing asset classes? US and, and large cap and growth, right? They're all at all time highs. What are they saying? We're going to get better returns in the future? Emerging markets, large cap international, small stocks, and value. Well, what's doing really poorly like right now? Those four things. So they're saying, like, look, eventually valuations will return to norms. So you should overweight these other asset classes. Well, they also said this in 2020, and that hasn't happened. Now we're 4.5 years in, and they've not been wrong. They've been 100% wrong. So, like, look, even Vanguard, Goldman, BlackRock, none of them can predict. These are expected returns. Doesn't mean it's what's going to happen, and it hasn't been right for the last 4.5 years. There's a very long period of time that can pass without regression. 2000 to 2010, the U.S. large caps earned zero. Every other asset class had very high returns. Then you flip it on its head from 2010 to 2020. US crushes everything else, and everyone expected it might flip again at the beginning of the decade. It hasn't happened. I don't think investors need to lower their expected returns. If you're diversified, you're all over the world, you're still going to get the expected return. It's just going to be coming more from value than growth, more from overseas than the US, more from small stocks than large. If Vanguard is right, I'd put if in capital letters.
Right, because we don't know that E component, right? The E
Right.
component can grow into it. Perhaps there'll be higher growth, and that's what certainly growth stock. I would say from this table here, the worst expectation you could make is that growth stocks, which have done high double digits, close to 20% returns over the last decade, assuming that will continue, you shouldn't be assuming that going forward. We had
Correct.
just an incredible run similar to the 1990s in terms of growth stocks. That doesn't mean they have to be down or flat over the next decade, but definitely temper your expectations. How about on the bond side, Peter? I know we've talked about this, but is it a little easier to project bond returns, and or is it better to be a bond investor today than let's say 10 years ago?
Yeah, I mean, for years and years and years, you were getting 1 or 2% from your bonds. Now you can get 4 to 5.5%. And the bond market sounds really confusing. There's more money traded in bonds in the first hour of the markets than the stock market all day. Ton more money in bonds. There's a lot more bonds than stocks. Huge market. But the expected return is really easy to figure out. The expected return of bonds is the payment you're going to get when you buy a bond. So if you go buy a bunch of bonds today that pay 5%, 99 to 100% of your return is going to be that 5%. And so it's very easy to predict future returns on bonds. The issue with bonds is when you're buying the bonds, you have to make sure that what you're buying is going to stay ahead of inflation. And that's the real bet. Like, are you buying bonds? If you buy 5% bonds, we wind up with 7% inflation while you're losing money. That's the danger with bonds, is retaining your purchasing power. But the expected return is actually easy to figure out.
Yeah, on this chart, I think the return will be within, let's say, a 90% probability will be that 4 to 5% range if history is any guide. And it should be because that coupon payment is constant. What happens in between isn't. The difficult one is, as you said, the bottom part there, that inflation number. How do they know for sure it's going to be 2 to 3%? Hopefully, that would be great. I think we would all sign up for that right now. But certainly it could be higher. Maybe it could even be lower. And you don't know. So, lesson I think here, just be conservative. The consequence of being conservative is, oh, you have more money at the end of the day because you saved more and we're a little bit more prudent in terms of spending. I don't think that's the worst outcome for a lot of people. All right, lesson number 3, lengthen your time horizon. He says here, the longer the time horizon, the less the variability in average annual returns. Investors should not underestimate their time horizon. An investor who begins contributing to a retirement plan at age 25 and then in retirement draws on the accumulated capital until age 75 and beyond would have an investment lifetime of 50 years or more. And before we dig into the data on this, Peter, I think this is an important point. A lot of people assume that that time horizon is when, let's say, they start retiring. And that isn't actually the case, right? Because most people live 20 years or more in retirement, and you're not withdrawing everything at once. And you're not selling all of your stock portfolio when you retire. Do you think that's important to kind of, I know we build that into our plans, to understand that your time horizon is not just when you start investing to when you start withdrawing?
Right. A lot of people think, oh, when I retire, I need to get super, super conservative because I've arrived at my destination. You haven't arrived at your destination. It's just the next chapter. And it is true. In the 1950s, life expectancy was actually the day you received Social Security. The average American got no Social Security because the date of Social Security was also the same life expectancy. Today, we're expected to live 20 years past that. So when people retire, they have decades left of needing income from their portfolio, and it needs to be in a position in a way to make that work. And what Bogle's talking about here is you have to think long run. Like if you look at 1 year of the stock market, the odds it's going to be positive are 3 out of 4. But if we go over a long period of time, it gets very, very close to 100%. You get more clear expected returns are more likely to come to reality the longer that you're invested. It's like being the house in a game of blackjack. The longer you play, the more likely you're going to get the expected outcome that you win.
Right. And in terms of that variability, you can see that really clearly on the chart here. In a 1 year time frame, you can have big up, big down, 3 year, same thing. As you go out in time, the odds of that downside really are diminished, and you go out 30 years, and the worst historical return for the S&P 500 is 8% per year. And most investors have that 30-year period when they're starting out for sure, and likely it's going to be even longer than that. So if you play that long game, the odds are in your favor. And just look at the variability here. Just look at the standard deviation in terms of those periods. And 1 year period, and this is the joke of it, like people are predicting, and we'll talk about this later, where the S&P 500 is going to be a year from now. That's the hardest game to play. Much easier to say the market's going to be up between 8% and 12% a year over the next 30 years. That is a very boring statement, but that's more likely to be correct than these short term forecasts. So definitely keep that in mind. And whenever possible, play the long game, lengthen that time horizon. Lesson number 4, stick to the good plan. And he says here the greatest enemy of a good plan is the dream of a perfect plan. Stick to the good plan. And what he's talking about here, Peter, I was watching a video, him talking about it, is the perfect plan would have all of the perfect stocks or all of the perfect funds, which is obviously impossible, right? If we look at the funds that have outperformed their benchmarks over the last 20 years, well, it's very, very few. The perfect plan would know that in advance and pick the funds that outperform. He's saying don't rely on that. Rely on something that has a high probability of success that's good, but not perfect. And that would be something like index funds, which obviously he started at Vanguard. And if we look at the S&P 500 last 30 years, you didn't have to have the perfect plan in order to do very well as an investor. You just had to stick with this broad-based index up 10.5% per year, 1,900% return over the last 30 years. When you're talking about a plan with a client, do you incorporate this concept good, perfect? It's impossible to get everything right, and the client is going to change, the markets are going to change. You have to kind of adapt to how things are changing over time.
That's right. I think in investing, it's relatively easy to say if we do this, there's an extremely high probability we'll be in the top quartile. But there's also an extremely high probability we won't be in the top 1%. And so a lot of people are trying to get that top 1%, not really realizing that it dramatically increases the probability they'll wind up in the bottom quartile. It's very interesting with investing how easy it is to be a excellent performer, but not a perfect performer. But people are reaching for perfection, and especially super successful people in a lot of other fields. If you do more, you do work your way towards perfection. Here, by going a little bit too far, you actually lessen your likelihood of success. So it's so counterintuitive, particularly to people that have had a lot of achievement in certain fields.
Yeah, it's kind of crazy to say if you're just average and you take the average, take what the market returns and nothing more, you're going to do better than most people because they'll be losing from paying higher fees or trading more and all that other stuff. And that was Bogle's big message, is to say, just take what the market gives you and minimize that other stuff. And that's going to lead by itself being in the top few percent of investors. I think even on the active side, someone like Howard Marks has always said it never strove to be the very best because you have to take inordinate risk in order to get there. And if they're just in the top 25% consistently, or even the top half, over time, if you keep repeating that, that's going to lead to be in the best among investors. Okay, lesson number 5, don't chase the past. This is something you and I have talked about a lot on the show. Buying funds based purely on their past performance is one of the stupidest things an investor can do. And that might offend a lot of people, but in actuality, we know this has hurt a lot of people. And so he's trying to send the message, don't chase performance. I think the best example, Peter, of this, and we've talked about in the past, but I want to update it again, would have to be the ARC funds. And since then, I can't think of another fund that is like it, right? In terms of capturing the attention of people. And you can see here the assets under management on the right here, how it just shot up after that huge performance in 2020. And the flows that came in 2020 and all of this 2021 was early in the year when the fund peaked. And then you see the outflows just starting to pick up here in terms of this fund. And why were people chasing it? Well, very simple. They were chasing performance. And what is the result over the last 3 years? Well, that famous saying from Bogle, the most powerful force in markets is reversion to the mean. We're seeing that here. Nasdaq 100 up 40% over the last 3 years. ARK Innovation Fund down 61%. Any other lesson investor can learn other than simply don't chase?
Well, I would tell you that the other big thing here is that the returns of the fund they're actually much worse than they appear to be. Because when the fund was doing really well, very few investors were in the fund, right? So then all the investors go in. When we're looking at your chart, all the
Yeah.
investors go into the fund just in time to participate in the slaughter, right? So they're all getting crushed. So while the fund has poor performance, right, way up and then way down, The average investor only participated in the way down. We saw this with Legg Mason Value too, where Bill Miller was the only person to beat the S&P 500 15 times in a row. Massive inflows, and then he performs in the top 1 to 3%, and all those people get devastated. So the average investor's return in a mutual fund that had a hot streak is actually much, much worse than the long-term return of the fund. And I think that's an interesting thing that's not really reflected in the statistics, is you don't really get to you don't really fully appreciate the carnage from looking at the graph.
That's right. So if we looked at a dollar return here, like more money has been lost than it's been made since inception of this fund, even though the fund is up 139% since its
Yeah.
inception. All of the money came in around here, right? And
Right.
now it's down huge and just kind of amazing, right? A lot of innovation in the NASDAQ 100. Very simple index, right? Just taking these 100 companies, and we know all the big names in it: Apple, Amazon, Nvidia, Google, Microsoft, or the vast majority of the holdings there. The NASDAQ 100, all you have to do is pick that. And since this fund started in 2014, we're looking at almost 10 years, a decade ago. NASDAQ 100 is up 5x, up over 405%. Arc Innovation, 139%. So there's always going to be funds like this, right? That
Yeah.
take a concentrated bet. They get, whether it was luck or skill, maybe some combination, we don't know. And then investors assume that that means it's going to persist going forward. This is my favorite study, Peter, on this, from looking at Morningstar data over a 10-year period, saying, look at the best performing decile of mutual funds. And if you bought those funds over the next 3 years, your return is 8% per year. And if you actually looked at the lowest decile, so the dogs, the worst performing funds, you actually would get over 2% higher. Kind of a crazy stat, maybe not surprising too, but I think the way most people pick funds is obviously the exact opposite of this. No one's going to look for a fund that has done bad over the past 3 years
Right.
and say, I want to get into that fund.
Yeah. I mean, in the active markets, we know this past performance not indicative, and this is just a great chart illustrating it.
Okay, so let's go to lesson number 6. Buy the haystack. Don't look for the needle in the haystack. Just buy the haystack. And I have an update here on this chart, Peter. This is kind of incredible. We talked about this earlier in the year. We talked about it last year. We've shown many different versions of this, but the top 3 holdings in the S&P 500 now make up a record 20% of the index, that being Microsoft, Nvidia, and Apple. They're all around 3 trillion in market cap right now. Just incredible dominance from these 3 companies. 20% of the index. Data going back to 1980, we've never seen anything close to this. And there's 2 ways of looking at this chart, right? The person that's saying, I want to pick stocks, I want to find that needle in the haystack, is saying, well, I want to find the next Microsoft. I want to find the next Nvidia. I want to find the next Apple. And that's going to lead to even better games because those stocks have really dominated. What do you say to people who are saying that?
That stock is probably in the S&P 500. Like if you look at Nvidia, that incredible story, that's what's really lifted the S&P 500 returns this year. That was the needle in the haystack. I mean, it was already in the S&P 500 and it came out of nowhere and just crushed everything around it, and it's lifted up the entire index return. And so, look, if you're looking for the next needle in the haystack, it might not be in the S&P 500 today. It probably is, but if it's not, it will be before it's one of the largest companies in America. And the amazing thing about a stock is, a bad stock, because a lot of people go, I don't want the S&P 500 because some will go to zero. Well, it's true. But the worst thing an S&P, a stock, any stock can do is go down 100%. But a stock can go up 1,000, 2,000%, as we see with Apple and Microsoft and Nvidia. And so that one high flyer offsets many, many, many losers and then some. And that's why you see the outsized returns of the broader index.
Yeah, so it's not impossible. You could make a concentrated. The odds are just way against you, and the reason for that is the vast majority of stocks actually underperform not only the market but underperform treasury bills, and it's because so few stocks contribute to most of the gains in the market, because it's way higher than the Pareto principle here. It's looking at just three stocks historically have led to all of 10% of the gains, and just 3% of stocks have led to 100% of the gains. We're talking about there's been 28,000 stocks since 1926, and this study has showed this very small percentage of them is leading to all of the shareholder wealth. And if you are picking stocks like we talk about the ARK fund, the reason why it's really underperformed the past few years, guess which stock it didn't have?
Give it to me.
Nvidia.
Nvidia, of course. Yeah, there we
and
go.
and they had owned it previously, thought
Oh,
it had run
no.
up
Oh,
too
that's
much.
hilarious.
Yes,
Oh,
right.
god.
So
Yeah.
that's the point. Like if someone they're studying it, they have 30 team of 30 analysts studying this every day, and they said we want to kick Nvidia out. They're no longer, I guess, innovating, and that has cost them tremendously. So as
Yeah.
you said, if you're a broad index investor, you already have these stocks. It's the only way I know to guarantee that you're going to own the Apples, the Amazons, and the Nvidias of the future is to simply own a Haystack. All right, lesson number 7, just stand there. Don't do something, just stand there, said John Bogle. And I want to play a video here of him talking about this, answering a question at one of these Boglehead conferences. I think he was 89 years old here, Peter, when he was talking about this.
Incredible.
Steve Floyd wants to know if the U.S. stock market suddenly went into an unexpected broad market decline of greater than 25% and still heading south. What would you tell us to help us stay the course?
Well, the first thing I'd say was, who the heck knows whether it's still heading south? It may have stopped going down at 25%, and a lot of them do stop in the 20-25% range. But, it's an opportunity to buy more, and certainly, there are a lot of funny ways of, it's not very hard to give advice on these kind of things. But the one piece of advice I would categorically give to everybody, for God's sake, don't stop a program of regular investing because the market goes down. You're killing the whole value of dollar cost averaging. And it may go down for a few more years. Who really knows? But so much the better when you're putting money in every month, because it will come back. I think we're in a little dangerous territory now, as I tell people. But the 25% drop, 35% drop is easily possible. It's always possible, just because markets are markets. So I think the questioner is right to say, what should I do? And I guess the answer generally is, don't do something, just stand there.
All right, Peter. Just beautifully said. So simple, but so poignant.
Yeah. Yeah. I mean, the average person, especially an American, the answer is let's do something. Like, let's do something. Right. But we know that most of the time when the market goes down 7%, it doesn't go down 10 and become an official correction, but it does about a third of the time. And we know that when we have a correction, the average correction is only 14%, but most of them don't become bear markets, which are 20% drops or more. But sometimes it happens. And we know when we're in bear market territory that the average bear market is 34%, but sometimes it's much worse, like 9/11, the tech bubble, 08, 09. You just cannot, no matter how much momentum you feel you see, you cannot predict where the market's going to go. If you're all in, you should stay all in. If you're an investor that's investing with every paycheck, you should continue to buy in with every paycheck and not react to the market movements.
And the funny thing is, Peter, this is back in 2018, not long after, and he was saying he was a little bit nervous. Not long after that the exact thing happened. We had a 20% very quick bear market in late 2018, and the market didn't keep going, and it went back to new highs in 2019, and then so on and so on and so on. Right? We see this time and again, and he's really emphatic in saying, for God's sake, don't stop that automatic reinvesting, especially if you have that long horizon. You're getting stocks at a lower price. That's the last thing you want to do during that period of time. And no one knows if 20% is going to turn into 30 or 40 or 50. Many people will tell you that they do, but nobody knows. And actually, if you're a long-term investor, standing there and continue to contribute is actually going to increase your returns. And if you can add a little more, as I always say, if you can add a little more when the market's down a lot, that's going to be helpful in the long run because you're buying in at lower valuations. Okay. That's 7 lessons from John Bogle. How do you apply these in your own investing journey? At Creative Planning, we're here to help. We're offering all signal or noise listeners this free wealth path analysis. What do you get with this wealth path analysis? A lot. You're talking about a free portfolio checkup. We're going to go through your whole portfolio, tell you if you're diversified, tell you if you should make any changes, retirement planning. Are you on the right road to retirement? Should you be changing anything in terms of savings or where you're allocating your money? Tax planning, hugely important to us at Creative Planning. We have a huge team of CPAs that look through everything. Roth conversions, asset location. So where you're holding bonds, where you're holding stocks, all of this matters. We'll help with all of that. And we'll do an estate planning review as well, which is extremely important to make sure you have everything in order. So reach out today. I'll have a link in the show notes to get your free wealth path analysis. Just overview of Creative Planning. We're in all 50 states, so we likely have a location right near you. 300 billion in assets under management. All right, Peter, I want to talk about a interesting article I saw in the Wall Street Journal. I want to pick your brain on it. I couldn't really it was hard to say where I came down on this, but I want to get your take first, then I'll tell you what I thought. This was a 7-figure signature. What are we talking about here? Well, a 401k plan, which there's a lot of them. And if you're watching this, you probably have a 401k plan or an IRA. Huge value of these accounts now, over 6 trillion in the US. This is as of 2022, so it's likely much higher than this today. But here was the story here. This man dies and he has a retirement account of over $1 million. And he had a beneficiary on the account, like a handwritten beneficiary from back in 1989. This was his girlfriend at the time. And they broke up and he never changed it. Right. So, in fast forward to 2015, he dies. He's 59 years old. Well, she's the one legally on the form, and they have her name here, as on the beneficiary form. He dies. He doesn't have any children. He doesn't have a will. And the court so far is saying that this money is going to her. And his brothers are fighting it, challenging it, trying to appeal to a higher court, saying that they should have alerted him that this old beneficiary form was out there. They're claiming they did. He worked at Procter and Gamble. And it's going back and forth here. Now, a lot of lessons, obviously, for everyone watching this in terms of checking your beneficiary forms. But how do you come out in terms of the morality of this? Like, she's only talking through her lawyer and saying, basically I signed the form. Do you think it's okay? She went on, had a family of her own. She has a few kids. She got married. But there's no sense that they had any type of relationship going forward. Do you think it's right or wrong for her to keep this money? And what do you strongly advise everyone on this watching this today to do in terms of their beneficiary forms?
Oh, it's completely wrong and immoral, obviously. I mean, this is clearly not his intention. No one's saying necessarily it wasn't his intention. But I think the warning here to people is you have to have a current will and trust that says who's going to get what you want them to get. And you have to make sure your beneficiary forms also are clear about who you want to get your assets. So even if you have a will that says I leave ABC to my sister, if your 401k beneficiary form says I leave my 401k to my brother, well, the 401k is going to go to your brother. A lot of people go, I did a will, so everything moves with it. The beneficiaries need to be listed as well. And then life events happen. Like in this case, this couple gets divorced decades and decades and decades ago, both go on to live completely separate lives. He forgets to remove her from the 401k. Clearly not his intention. The form is going to win because what else is the court system supposed to rely on? They're going to rely on your will or trust to govern all of the assets without a beneficiary form, generally speaking, and they're going to rely on the beneficiary forms as, hey, what better guidance for where you wanted to go than whose name you put on the beneficiary form. So make sure you have those things right.
And when you see clients come into creative planning, do you see a lot of people who have put this off in terms of having a will, having a trust, this other stuff, and this is something immediately we can help with this, and you need to have this, and you should have this because this is the problem you're going to create when you pass away?
What I find is that I think that I'd say 90% of the people that are coming through here, they have an estate plan, a will or a trust, and they have beneficiary forms. But I would say of those 90% of those plans are not optimized. A beneficiary form is wrong, or it's not set up in the tax correct way, or a charitable gift is going from the wrong type of account, or the trust isn't coordinated with the forms. That's really more what I see is the plan's not optimized.
Right. And in terms of putting everything in order, I know you were talking to the whole company recently about annual reviews. And that's a good way. You have everything in one binder, everything in one place, and things might have changed, right? With your
Mm,
children, with other things in your life. And that's a great opportunity for us to help you at creative planning in terms of let's update it. Your life has changed. Let's update this now. So you worked hard for this money. Let's make sure it goes to where it's supposed to go and you want it to go and doesn't create problems after you pass.
that's right.
Okay, so I'm going to move on to signal or noise. And by the way, I agree with you there in terms of I wouldn't have accepted it, but I was talking about with a friend and they were saying, "Well, what if she was in a bad place financially and she needed this money? Like how many people would really give it back?" Like,
Right.
it's probably not a high percentage, I don't believe, right?
I got to tell you a story. So the
Okay.
first encounter I got that was kind of like someone threatening us with legal action. It was, I don't know how many years ago it was, but some client in New Mexico had left everything to his daughter, but the documents were done in a way where there was a debate on if it should have gone to the wife. So anyway, he passes away. The daughter collects the money, and then the wife threatens to sue the firm because the money went to the wrong place. So the way they wanted it to work was for the daughter to keep the money, and then us to pay the wife. So in other words, for the same family unit to collect double. So I would just tell you, the second somebody has money in their account, there are a lot of people that really like morality just kind of goes out the window. And I think just based on what I've seen, that beneficiary form situation, I would guess over half of people would keep it, knowing full well there was no intention that that's where that money was supposed to go.
Yeah, I agree. Maybe I'll do a Twitter poll on that and see and see what people say. But last
Yeah.
question on that: do you think there's a way to preempt that? That perhaps people they should sit down before they pass with the executor, the people that and let them know the plan right in advance. Do you think that's rather than it being a surprise?
Yeah, I mean, like, it is crazy to me that for a lot of people, their single biggest asset is their retirement plan, and we're dependent on a form that most people have not looked at in decades to dictate where this most valuable asset is going to go. I think everyone should be talking with somebody, right? Their financial advisor or their attorney or whatever, about reviewing everything once a year and just make sure, is this really all going the way it's supposed to go?
Yeah, right. Great advice. All right, let's end here at signal or noise. We want to update people. We're not just telling you is it signal or noise. We want to show you what happened after the fact. Here's a few examples here. Number one, this was from late last year. We're talking about presidential election years are bad for stocks. That was the headline. We talked about the data doesn't really support that. Most presidential election years actually show higher returns than the average year, up 10% a year versus 9.7% for non-presidential election years. And lo and behold, not just 10% this year. We're not even halfway through the year, Peter, and we're up close to 13%, and even more if you count today. I don't know where the market is currently traded, but it's running higher in advance of the Fed meeting. And how about this factoid here? This now is the best start to a presidential election year in history.
Yeah, it's incredible. It shows how unpredictable it is. And I think that, like, look, can you guess that there's the AI revolution is going to take off in the last 6 months in a way it hasn't for the previous decade? Obviously, has nothing to do with the presidential election,
Yeah.
but it shows why these statistics around, presidential elections really are not. To me, they make me think about when you're, watching a baseball game and they go, on evening games, on AstroTurf, on the road, this player's batting average is this, right? I mean, like, is
Yeah.
that really what the factors are? I mean, statistics can be interesting, and I think election year returns is one of those statistics that's largely meaningless.
Yeah, 100%. But it is nice to have this situation where we've been telling people all year, don't make any changes based on the election. If the market was down 15%, it would be pushing back. Now, of
Yeah,
course, that's possible, and that is going to happen sometime. But the broader point is there's nothing about these years and that suggests that you should make a change in your portfolio. And it's nice so far that it seems to be working out. Okay, another update here. This is a fun one, Peter. We just passed this today. We're not even halfway through the year, and we're ahead of every single strategist forecast for the S&P 500. I think we're now 12% above the average target at the start of the year. Kind of remarkable how quickly, and this has been the case the last 3 years. Every year it's been either higher or lower. 2022 being lower. Every year it's been either higher than all of them or 2022 lower than all of them.
Well, I mean, how about JP Morgan? They expected the market to be down, 13%, and instead it's up 12%. I mean, imagine making investment decisions based on their strategist predictions,
Yeah.
right? I mean, like, it's just shows how
Thanks.
unpredictable things are. Now,
Yeah.
the year's only half over. That analyst might wind up being right, but it just shows how arbitrary all of this is.
I'm technically a strategist, I guess. I don't do these four, but I'm gonna do mine on December 31st.
All right, perfect.
I think I feel pretty good about my odds. Okay. Last one here. We got a big Fed meeting today. They always say it's a big meeting. We know what they're gonna do. They're not gonna make any changes, but the hope is that they're gonna start cutting rates in September. CPI came in a little bit better than expected today. And so a lot of people are bullish about that. And I would just say, in terms of the Fed funds rate, like we said from the beginning, I think we covered it on the first show. Stop looking at the Fed funds rate in terms of dictating your investments. The S&P 500 is now 25% higher than where it was when the Fed started hiking rates in March 2022. It wasn't an impediment at all. So to believe that you need a rate hike or a rate cut, or that a rate cut is going to be this amazing bullish thing, maybe the stock market will go up, but not because of that rate cut. And we've seen many times in the past, stocks actually go down when the Fed is cutting rates. We saw that in 2008. We saw it back in 2001 and 2002.
Yeah, I think that, like, I did a letter on the inversion of the yield curve and how meaningless that can be as well. I actually think in September, if we don't get the rate hike, the market could really get hit hard. I mean, everyone is expecting that nothing's going to happen until then. I think it's going to be very fascinating to see the data that comes out, all the economic data that comes out between now and then, and where we sit going into that election.
Yeah, I would have agreed to you coming into the year, but now it's like every month we're pushing it out, and the market was expecting 6 to 7 coming into the year, and now we're at 1 to 2, and we got the best start to a presidential election year in history. So it just goes to show you, rate cut, rate hike. You know, the idea that one is super bullish and the other one's super bearish. That's not actually the case based on the data. Anything can happen, as you said when we started in the first section. There's so many factors that go into the stock market, and this is just one of them. It's not that it's meaningless. It's that you have to take a broad view. And if the Fed is cutting rates because unemployment is going up and we're headed for a recession, that might not be a good thing because earnings might be going down, and so on and so forth. Okay, we'll end it right there, Peter. Great show. Thank you, everyone, for joining us. If you're watching this on YouTube, hit that subscribe button. If you're watching this on Spotify or Apple Podcasts, you can follow us there as well. And we'll see you next time on Signal or Noise.